Welcome to my YouTube channel Equity Horse, your destination for equity insights and valuations. Today we dive deep into HDFC Bank, the undisputed leader of the Indian banking, known for its retail dominance, digital age, and unmatched asset quality. The title is HDFC Bank, the consistent compounder, retail power, digital age, and financial strength. Please subscribe my channel Equity Horse. Let us proceed further. Company overview. HDFC Bank Limited is India's largest private sector bank by market capitalization and is a leading provider of retail and digital banking services. Founded in 1994, it is founded in 1994 and it has consistently demonstrated superior growth, prudent risk and management and technological innovation. What is the core business segments? Its core business segments are the retail banking, 52%, about 52% of total loans, wholesale segment, corporate banking, about 30%, treasury and others, about 18%. After the merger with HDFC Limited, that is completed in 2023, HDFC Bank emerged as a universal financial powerhouse, expanding its footprint across retail mortgages, affordable housing, and insurance distribution. Let us see what is its market cap. Market cap is 12.5 lakh crore. It is in October 2025. Investment thesis. What is investment thesis of this HDFC Bank? HDFC continues to deliver consistent growth in an evolving credit cycle, leveraging its strong liability franchise, superior asset quality, and expanding digital ecosystem. What are its key positives? A strong retail loan momentum led by personal loans, auto and mortgages. A stable NIMs, net interest margin, despite cost pressures and merger transition, best in class asset quality and risk management. It has managed its risk very well and it also has class asset quality. Leadership in digital banking and customer acquisition. What are the key risks of HDFC Bank? Margin compression from higher funding cost post merger, increasing competition from RCC Bank and Axis Bank in digital lending, potential rise in retail NPA if macro conditions weaken. Around the three pillars, this investment thesis revolves around three pillars: consistent retail growth, impeccable without any mistakes, risk management, and digital innovation. Post-merger, HDFC Bank is positioned for a decade of compounding excellence. Retail loan growth analysis. Retail loans remain the growth engine, rising from 7.54 lakh crore in financial 23-23 to an expected 11 lakh crore by financial year 2025. The merger with HDFC Limited turbocharged name loans, while digital channels are driving personal auto loans disbursements. Post HDFC merger, retail loan book has expanded aggressively due to integration of mortgage assets and cross-selling synergies. The bank's focus on digital loan origination and pre-approved credit has enhanced scalability and with lower incremental cost. Digital retail dispersal channels: 54% of the personal loans and 42% of auto loans sourced digitally. 10-second loan platform has become a benchmark in instant retail credit. It has opened 10-second loan platform that is provide in 10-second loan. That is become benchmark for HDFC Bank. Share it in total loans 51% in financial year 23 and 54% now 25 56%. Auto loans growth 15% in financial year 23 in 24 18% and in 25 19%. Personal loans growth 23 in 23, 26 in 24, 24% in 25. Home loans growth post merger 11% in 23, 17% in 24 and 18% 25 expected. What is the CAGR 3 years 14.5%. Compound annual growth rate is 14.5%. Very excellent in 3 years. Asset quality and risk management. HDFC Bank asset quality is in industry leading with GNPA at just 1.24% and NPA below 0.35%. Even during micro headwinds, the bank's credit discipline and superior framework shield profitability. HDFC Bank asset quality remains best in class, supported by disciplined underwriting, strong collection infrastructure and advanced risk analytics. The merger-related stress has been minimal due to HDFC Bank's limited high-quality mortgage portfolio. Case insights: even during the 2020 COVID shock, HDFC Bank's GNPA gross net performing asset rose marginally from 1.2% to 6% to 1.47%, while peers like Axis and ICICI Bank saw spikes above 2.5%. This demonstrates the bank's resilient credit culture. In financial year 23, let us analyze the year 23, 24, 25 and peer average. In parameter gross NPA 1.12% in 23 and 1.24 in 24 and 1.28 25. It is increasing gross NPA. Peer average was 1.95 but below from its peer average. Net NPA 0.27, 0.31, 0.33%, 0.6 peer average. Provision coverage ratio 76% in 23, 75% 24, 75% 25 and 70% for peer average. Credit cost 0.55% in 23, 0.58 in 24, 0.6 in 25 first quarter, 0.78 peer average. So it is HDFC Bank is performing very well. Digital ecosystem and margin. With 95% of transactions now digital, HDFC Bank is transforming into a tech-led financial ecosystem. Its AI-based credit engines and are embedded finance tie-ups with fintechs give it a margin advantage over traditional players. 95% of transactions now digital. 22 million active users are on HDFC Bank mobile app. Leveraging AI-driven trade models and embedded finance partnership with fintechs. Net interest margin parameter 23 4.1%, in 24 3.9%, in first quarter of 25 3.8%. And peer comparison with respect to ICICI Bank 4.4, Axis 4.2. HDFC Bank is performing well. NIM compression is visible due to merger impact and higher cost of funds. However, management expects NIM to normalize to 4% by financial 26 as loan mix shift towards higher yield retail segments and cost synergies materialize. Digital origination reduces cost to income ratio by 50 basis points annually, offsetting funding cost pressure. Now we analyze peer comparison in snapshots. Financial 24. Bank HDFC Bank NIM net interest margin 3.9%, return on asset 2%, return on equity 16.2, GNPA 1.24, CASA current current and saving account. CASA ratio 42%. PB, PYB, price and book value 2.7. Retail share 54%. ICICI Bank, NIM 4.4%. ROA 2.3%. 17.8% ROE. GNPA 2.02. CASA ratio 45%. PYB ratio 2.8. Retail share 53%. Axis Bank 4.2%. NIM ROA 1.9%. ROE 15.1%. GNPA 1.8%. CASA ratio 43%. P2B ratio 2.3. Retail share 48%. Kotak Mahindra Bank, NIM 4.9%, return on asset 2.1%, return on equity 13.5%, gross non-performing asset 1.9%, current and saving account 56%, price book value 3.1, and retail share 64%. While ICICI Bank currently delivers higher NIM and ROE, HDFC Bank remains superior in consistency, skill, and risk-adjusted returns. Its long-term performance stability makes it a preferred institutional pick. Margins show mild compression due to the merger effect and higher funding cost. However, digital cost efficiency and retail mix normalization are expected to lift NIMs back to 4% by financial year 26. Financial performance highlights. While ICICI Bank currently leads on margins, HDFC Bank remains superior in risk-adjusted returns, scale, and franchise strength. A key reason why institutional investors continue to hold it as a core portfolio stock. Let us analyze financial performance metrics on these parameters. Financial year 23, financial 24, financial 25 expected. Net interest margin in crore 88,100 for 23 year financial 23. In financial 24, 1,06,100 crore, and expected it is 25, 1,23,500 crore. Profit after tax 44,100 in 23. In 24, 56,500. In financial year 25, expected 65,000. Earning per share in 23 financial year 23 80, in financial 24 95, in financial year 25 expected 110. Cost to income ratio in 23 39, in 24 40, and expected 38 in 25. ROA return on assets 2% 23 in 23, 2 in 24, and 2.1% expected in 25. Return on equity 16.5% in 23, in 17% 24, and 17.5 in expected in 25. What is trend? BC sustained double-digit profit growth and improving efficiency ratio, reform management execution strength. Now look at its valuation and outlook. A strong growth. Continued net interest income up 40% in 2 years, and profits on track to cross rupees 65,000 crore in financial 25. HDFC Bank consistent execution makes it a compounder in the true sense. Valuation outlook, valuation metrics, EPS, book value per share, target price book value, target price, CPM, current market price, upside potential. In financial year 25 expected and financial 26 expected. EPS 110 in 25 and in 26 125. Book value per share 640 in financial year expected 25 and in 26 it is expected 710. Target price book value 2.8x in 25 expected and 2.6x in 26 expected. Target price 1800 in financial year 25 it is expected. Current market price is 1600. Upside potential 12.5% it is expected upside potential. Valuation rationale: given the bank's long-term stability, superior franchise, and retail-led growth, we assign a premium multiple 2.8 financial year in 25 expected book value per share versus peer average of 2.4x in 25 expected. The merger with HDFC Limited is expected to be EPS accretive from financial 26, enhancing intrinsic value. The intrinsic value of HDFC Bank will be increased in 26. It is expected. Seeing this, its performance. Analyst recommendation. Our channel Equity Verse is not recommending because it is only education purposes. My channel is only for education purpose, not recommended. If you want to advise about HDFC Bank to buy, hold or sell, you please consult to financial advisor, financial analyst. Target price 1800, investment horizon 12 to 18 months. Risk taking moderate. Key triggers: margin normalization post merger, cross selling synergies from HDFC Limited customers, stable asset quality and amid rising retail mix, digital lending expansion and cost efficiency, faster current and saving account ramp up, rural and semi-urban penetration, improved operating leverage via digital channels. HDFC Bank is trying to capture rural and semi-urban area so that its business will be improved. ESG and sustainability snapshot pillar: environmental social governance. Key highlights: green loan portfolio of rupees 18,000 crore, commitment to carbon neutrality by 2035. Environmental area: social 51% workforce diversity, financial inclusion programs is in 650 plus districts. Governance board with 6 independent directors, high disclosure standards. ECG score 75%, high governance strength. In conclusion, HDFC Bank is the gold standard of Indian banking, combining growth, prudence and digital buy on dips. Candidates with a compounding potential of 13 to 50% CAGR. Thanks for watching Equity Verse, your trusted channel for equity in figure mutual fund research, insights, mutual fund research and portfolio mastery. Continue with our YouTube channel Equity Verse. Until we will meet in next video, I will come with new company analysis. Till that,